Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's August 22nd, 2023. It's a Tuesday, back in the South Florida office. We got a big show coming up for you. We're going to take a look at this pullback in the market. Half the people out there are saying this is the beginning of a bear market. We never entered a bull market. We're going back down to test the lows from October. The other half is telling us this is a great buying opportunity. We're going to go through 15 sector charts of ETFs to show you what's really going on and pick some names in there that you may want to put on a watch list. We're going to talk about COVID. Is it coming back? The Fed meeting and Nvidia earnings on Wednesday. All that and more coming up right now on Making Money. Nvidia may be America's top performing stock after more than doubling this year alone. But if you're holding Nvidia or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular in many news outlets from Fox Business to CNBC and built the stock indicator Wall Street uses to find winning stocks. His award-winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found Nvidia at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from Nvidia. My system has indicated that Nvidia is no longer the best stock to buy to profit from AI, is what Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzy23.com. Again, that's aifrenzy23.com for a free copy of his new report. Once again, this is Matt McCall. Thanks for joining me again, the 22nd of August, 2023. Every time I say the date, I can't believe what date it is. It's going so darn fast. I just did my schedule for conference season coming up, traveling a lot. In the last, 72 hours, I've been in Nicaragua, Florida, LA, back to Florida, and a lot more between now and Thanksgiving coming up. So I'll be seeing a lot of people out there on the road at different conferences, everywhere from LA to Vegas to Toronto to Baltimore to Florida to Portugal. And if you see me out there, come by. I'll buy you a coffee, a tea, or something a little stiffer if that's what you want. But we have the market pulling back, and we had one hell of a run to start the year. And about a month ago, market started getting a little toppy. It was a bit overextended in near term. And, me being, as what many people call a perma bull, bullish really on the world, bullish on the economy, bullish on the stock market, bullish on human beings in general. Granted, you have some times where you second guess that, but that's generally how I like to live my life, as more of an optimist versus a pessimist, which these days, unfortunately, is quite rare. That being said, about a month ago, I started saying that, hey, listen, the market could pull back a good 5% from here. It's okay. Nothing goes straight up. And if we take a look at what's going on in the market here as of late, you will see that there has been a little bit of pullback here in the overall market. I'll show you a chart here in a second that shows a pullback. As you can see here, I picked a couple indices. This is the S&P 500, the QQQs, which is NASDAQ 100, Russell 2000, small mid cap, the ARK Innovation ETF, ARKK, and then TLT, which tracks the long bond. You can see all pull back, and this is the pullback from the most recent highs, or the last time it hit an all-time high in the case of the bond market. And this was heading into Tuesday. The SPYs, the S&P down about 4% from the recent high that we had, which was a 52-week high. NASDAQ down 5.5%. We have the Russell 2000 small mid cap down 7%. We have the ARK down almost 19%, the Innovation ETF. And then we have, of course, the TLT there, which is the bond market, still down, continues to hit lower lows, down about 15%. And the reason I want to show you that was a lot of these outside of the bond market were at 52-week highs just a few weeks ago, and they've all pulled back since then. And while that is important, I do want to show you another chart here that kind of breaks it down a little bit more, and this is going to be really how they've performed year to date. And if you take a look at how they have performed year to date, look at this chart. you can see still a lot of them are up. Everything but TLT, which is the bond market, continues to go lower. You can see the QQQ is still up 36.5%. ARC still up 31.5%, even though it's down about 19% from the time that it hit its most recent high. My point is, we still have a hell of a year, but we have pulled back from those highs. And if I would have told you about a month ago, hey, listen, you love innovation, maybe you're interested in the ARC Innovation Fund, what if I allow you to buy that 20% off the high, which it was just at a couple of days ago? You'd say, yeah, I'll take a shot at it, 20% down. But now that it's down 20%, now that NASDAQ 100 is down 7%, you start questioning and saying, well, maybe this isn't a good buying opportunity. And maybe this is the time to be selling. Maybe this is the beginning of the next bear market. So let me show you here a chart of the S&P 500. This is the SPYs. And we're, of course, taped the show early in the morning. We're up about 0.1%, near the lows of the day. But the S&P rallied to a 52-week high in late July. We then pulled back, and we're finding support at the low of June when we pull back, which happens to be the high from last August. When you put that all together, we have a very important support level around 430 on the SPYs. We're around 440 right now. So we're not too far above that. We came down to about 433 just last week, so we came close to that support level. The point I'm trying to get across here is, if you've been contemplating getting back into the market, and I'm going to show you a bunch of ETFs and stocks in a minute, but you've been contemplating getting back in the overall market, this pullback gives you a really nice reward to risk opportunity. Your reward is that it bounces off here, and if the trend continues, you hit a new high. And looking at the chart of the SPYs I mentioned, we're around 440 right now. If the trend continues, you probably put us around 480. It's about 40 points to the upside. So a little less than 10%. Let's call it 9%. On the downside, if it breaks 430, you could probably, say, okay, listen, this will probably continue this downtrend for maybe a month or two going into the second or the last quarter of the year. And in that case, you can maybe put a tight stop, and your risk is low, your reward's pretty damn high. So buying on pullback gives you a lower entry price. At the same time, it lowers your risk because you're closer to support. So the risk goes lower and reward increases, making the reward to risk ratio more attractive. So you want to buy on pullbacks like this. And I've been making a career out of it. And it doesn't always work. Sometimes it breaks the support. Sometimes you got to get out. But buying on pullbacks definitely is the way to go versus trying to chase highs, which for some odd reason, people feel much more comfortable buying a stock when it's hitting a new all-time high. So Friday, just to wrap up what's going on this week before we jump into the ETFs and the stocks. Friday, we have the annual Fed meeting held at Jackson Hole. It's actually Thursday, Friday, Saturday. But Fed Chairman Jerome Powell speaks on Friday morning around 10 a.m. East Coast time. So expect the markets to move on those remarks. This is their annual Fed retreat. It's been going on, I think, since 78. It's been held in Jackson Hole, I believe, since 82. Economists from all around the world, central bankers from around the world all come, talk, have a good time outside in Jackson Hole, and have different speeches from different people. The title this year is Structural Shifts in the Global Economy. You can't get much more generic than that. But I think what they're trying to get at is, especially in the U.S., we went from a pretty long time of zero interest rates, and shot up to one of the fastest interest rate hikes we've seen in a long time, from zero to a range of 5.25 to 5.5. And that's where we stand right now. So that shift is from zero to where we are. The shift is inflation went from below 2% up to over 9%, back down to 3%. So I think there's going to be a lot of talk about what the Fed's next move is, which, of course, we want to keep our eye on as investors. The chance right now for a rate hike at the September meeting by the Federal Reserve is up 13.5%, so kind of low. November chance goes up to 43%. There's a 95% chance by the end of the year we have at least one rate hike. But as we know, the Fed has been a wild card, and we'll see how it goes. A lot of it has to do, obviously, with data that comes in between now and the end of the year, whether that be inflation numbers, obviously, which are extremely important. GDP numbers, not as important, but then there's the jobs numbers. We'll see if the jobs market slows a little bit. That maybe you can keep the Fed on sidelines. A lot to be determined, I'd say, in the next couple of months. Other big event is Wednesday after the closing bell. Nvidia, who was referred to recently as the Godfather of AI, of artificial intelligence, which, as a matter of fact, Nvidia stock this morning, folks, rallied to a new all-time high. It's now down, but it hit a new all-time high. Again, well above $1 trillion, but now in a low today, now down nearly 2%. We'll see what happens with Nvidia, but when earnings come in after the bell on Wednesday, I think the stock could either be up 10 to 15% after it or down 10 to 15%. It can go either way. And anybody who's going to try and play that, whether buy it or sell it prior to the announcement, is pure gambling. I really think you're same odds as sitting down at the blackjack table, actually probably a little less, because I think the odds here are about 50-50. I don't think anybody has really any insight into the numbers. Number one. Number two, how the market will react. Because even if Nvidia comes out and beats the numbers, it could still sell off. It could be buy the rumor, sell the news. So I would be very, very careful. Actually, I wouldn't be careful. I wouldn't do it. Again, I think your odds are better at blackjack if you played a book right, because it's slightly above 50%. So you actually have better odds. If you want to go do something, go play some blackjack, if you know how to play. And then the last thing to talk about before we jump into this is it's starting to concern me, not from a health perspective of anything like that, but concerning me because I know where the media comes from and I know where the media goes. I've seen it just this past week when I flew home from California on Sunday. All the talk of this hurricane, then a tropical storm and all this stuff. 25-mile-an-hour winds. Last time I checked, that was just a normal rainstorm in Florida with some rain. So obviously, I know there was some flooding, and anybody who lost anything, I feel for you. But my point is that the media made it out as if it was going to be some type of catastrophic event that was going to destroy Southern California, and that just was not the case. So when I look at COVID, I see some headlines coming out. I saw a headline from CNBC. COVID vaccine stocks jump as new variants emerge ahead of fall shot rollout. From the Tampa Bay News, some Tampa Bay stores out of COVID-19 test kits after uptick in cases in Florida. Then from Deadline, Lionsgate, which is a film production company, Lionsgate reinstates mask mandate in parts of Santa Monica office during COVID outbreak. Another one, Atlanta College reinstates COVID-19 mask mandate, students return to city. I got to tell you, folks, if this government, and again, I'm neutral. I don't care if you're left, right, or upside down, tries to impose these mask mandates, these shutdowns, these tests that you must require to go places, again, we're doomed. I hate to say it. And again, I'm an optimist. We are freaking doomed. It's just people will uprise. Nobody's going to stand for it. I'm telling you right now. And again, I'm not saying vax, no vax, test, no test. People don't want to be told what to do. They don't want to be told. And again, I hope this is just something that goes quickly. But what concerns me is the movement that we've seen in the vaccine stocks. That concerns me because the markets will tell us and money will tell us what's going on. And here's just a quick chart of BioNTech. And this is obviously with Pfizer. See, the stock went from $95 to $121 in 2 weeks. That's a hell of a return. It's about a 30% return. Trading now at the best level since April. Moderna, obviously we all know Moderna, the mRNA. Again, up from below 100 to about $114 in a matter of 1 week. So they're moving, and we need to keep an eye on it. So my fingers are crossed. We don't have to deal with that BS again. But on a more optimistic note, we're going to go through a lot of charts here because there's a lot I want to look at. And I found 15 ETFs in very niche areas that have pulled back, sitting in support that I think I found fascinating and I found interesting. And I put on my watch list, not to buy the ETFs, but to track the sectors. We do top down, look at the market, look at the sectors, and we go down to individual stocks. And we have some individual stocks we will name. The first two we're going to take a look at here have to do with robotics. And here's ARKQ, which is the ARC Autonomous Technology and Robotics ETF. As you can see, pulling back from a yearly high we hit in July, right down by that high that we hit in February, holding some nice support. The other one we have is very similar. It's BOTZ, BOTZ, Global X Robotics and AI ETF. Again, rallied to a year high in July, pulling back to the level that we have a big base back from April. Two that look really good pulling back, two that have really good themes. The next one is ARKK, which is the big ARK Innovation ETF. Again, rally to a year high, pullback, sitting on the 200-day moving average, sitting on the price support going back to March and April. Again, looking pretty damn strong. Another ARK in here, and I just didn't pick ARK specifically, but a lot of them really great charts. This is the ARK Next Generation Internet, ARKW. Again, rally to a high, pullback to the February high. Then we have HACK, HACK. This is the ETF MG Prime Cybersecurity ETF. A very similar chart, folks. I don't need to kind of say it over and over. Two more here that are in niche areas as well. One is Sky, SKYY. This is cloud computing. This one, again, rally, pulling back. And then the last one is a social media ETF, SOCL. This is Global X Social Media. Again, rally to a year high, pulling back to a support level at this point. I knew I flew through those, but I did that for a reason. And the reason why I want to do is just want to kind of get those out there and get that in your mind as to what's been going on here. And I'm going to show you now a chart. And this is a year to date of all those ETFs. And again, it looks messy, but what this chart shows you is you can see on the right-hand side, they've all pulled back as of late. And everything from the biggest gain here, even with the pullback, is the ARK Next Generation Internet ETF, ARKW, to the smallest, which is the Russell 2000. I threw it in here as a comparison. But then you have the cybersecurity hack up 14.3%. Still not a bad year to date for anything out there right now. But you can see a lot of them have pulled back from that level. So what I did is I went through the top 5 holdings of all these. And I looked at some stocks that had similar charts. And that's what we really want to get at. That was just quick to give you an idea of what's pulled back. Now, let's take a look at a couple of these companies. First one we're going to take a look at, and this comes from the ARKQ, which is the robotics ARK. This is KTOS. This is Kratos Defense and Security. Really nice looking chart. It formed this big gap back in August, rallied to a new year high, pulling back to that gap, filling it right now. Nice uptrend since December of last year. It's really moved since then. This is the kind of company, in my opinion, that flying under the radar, not a real big name, so it's not something that everybody out there is talking about, makes up a big portion of ETF. And again, remember, I don't want to buy into these ETFs because when you're buying into something like ARKQ, which is technology and robotics, you look at the holdings, it's got 25. So it's highly concentrated. However, it's got 12% in Tesla. So unless you love Tesla, you shouldn't be buying that ETF because it makes up such a large portion of it. And it's a huge company. Where Kratos, on the other hand, is a $1.9 billion company. They do technology platforms for integrating different types of electronic products. They do work with space training. They do some rocket support, unmanned systems. So it's in a lot. It's kind of a space. It's a defense company, really. But because of the unmanned systems and the work that they do with that, it can fall into the robotics area. And that's why it fits into this ETF. And, again, what I like about the company is really flying on the radar. It's got really nice fundamentals. It's trading just over 2 times sales. It does make money. It's been making money for a couple of years, which is really important for a smaller company like this. So again, just something to throw out there. But a lot of times you can use these ETFs as ways to find new interesting companies. I have a bunch more here, but I'm going to skip through a lot of them. And I'm going to go to one, and this is a bigger name. I've talked about this in the past. This stock has pulled back as the price of Bitcoin has pulled back, along with the overall market. And this is, of course, Coinbase, Coin, C-O-I-N. You can see in the chart, it rallied about $115 a share in July, since pulled back to around 70. Really nice price support there. It's got a gap that it's filled going back to the March timeframe there. And, a lot of this obviously hinges on the price of Bitcoin, which is hanging around right above 26,000, but it had a big drop in the last week, down about 10%, a little over 10% drop. So we'll have to see. If Bitcoin doesn't hold here, I think Coinbase could be in trouble. That being said, if you think the price of Bitcoin can hold, I think this is a great buying opportunity. And, all the stuff with the SEC and everything going on, I think that's smoke and mirrors for garbage. I think there will be a spot Bitcoin ETF approved at some point in the near future. I know I've been saying that for a while. So I sound like the bears saying there's eventually going to be a down market. So I apologize for that, but I do think it will be approved in the near future. I think Coinbase will come out of this as probably one of the strongest companies out there that you want to own in this space. And again, this pullback looks pretty darn good. But again, if Bitcoin breaks down, I think this is all out the window. I think Coinbase could fall much further. And the last one is a company that we all know and love. I love it. I have about 4 packages coming today, and that's Amazon. Amazon rallied to a year high, gapped up and pulled back in August, filled that gap, sitting on a 50-day moving average. Still a great company, and I don't see Amazon going anywhere anytime soon. Continues to incorporate AI, which it's been doing for a very long time. Continues to dominate most areas of retail. So Amazon, to me, still a great company. A huge company, obviously, but still a big company. And that's the number 2 holding of Sky, SKYY, which is a cloud computing ETF, which obviously because of the AWS services that they offer, which is a huge portion of that company at this point. A couple other ETFs here I want to take a look at. I have 15, but there's too many to do. So I'm going to skip down to the next section. And these are 4 ETFs that really don't have much to do with technology, but have pretty good looking charts, and I think they cannot be ignored. The first one is a U.S. Global Jets ETF, JETS. When I say JETS, it sounds like a New York Jets fan. JETS, Jets. And my producer, Greg, is a Jets fan, the poor son of a gun. Maybe they'll actually have a decent team this year with Aaron Rodgers. I think he gets hurt. I think it's over for them. But maybe Zach Wilson comes in and does something. But anyway, Jets ETF is pulling back from a year high around 22.50 down to 19. Got great support there going back to April and May. And again, I've been on so many planes, folks, recently, and I have so many flights booked, and they're full. The last time I've been on a plane that wasn't full, I couldn't tell you. I don't think in the last year and a half. I think it's, when I say full, maybe 1 or 2 empty seats, but I'm talking full. Usually they say there's no room above there for people coming on the plane because we have a full plane, and it's there. And fuel costs have gone up, oil prices have gone up, so that concerns me a little bit. I just saw American Airlines jets are getting, I think, a 46% pay increase or something like that. So there's always issues. It's not the greatest business model. All that being said, travel demand continues to increase. Looks like we're getting a little more increased travel for international as well, which is a good moneymaker for a lot of these companies. So I like the pullback that you see on this chart for jets, and it's got a lot of tailwinds, no pun intended, behind it. Another one is CGW. This is a global water index ETF. And you see it pull back from a high around 53 down around 49, still along the uptrend that it has right there. So this is an area that people ask about a lot, water. I wrote about it probably 05, 06, maybe prior. And I have a whole chapter about it in my book called The Next Great Bull Market, which don't go out and buy because it's 15 years old now. But it came out in early 2009. I was writing about water then. And I always thought to myself, well, those investments didn't do too well. But a few months ago, I went back and I looked at how the investments that I talked about in that chapter did. There's a lot of huge winners. There's some almost 10x winners in there for water utilities in 15 years. It's tough to really outdo that. But CGW, I think it's a great way to look at kind of combating what's going on with the weather and events around the world. These water companies are extremely important. Unfortunately for the customers, water prices continue to go up, but it is an area that does very well in a lot of different times. Utilities, that is, and the fact it's still holding up with interest rates going up is important, because even though the SEC 30-day dividend yield is only 1.6%, these are still some water utilities in there. So it is something that you want to consider, that if yields come down, this should do actually even better. 2 more kind of random areas. One, the symbol's CRAK, C-R-A-K, and that has to do with refining. It's an oil refining ETF. And you can see here, this one hasn't pulled back as much, but the chart looks pretty damn good, and oil prices doing well. So I just want to throw it in there for you here real quick. The last one is copper. Copper miners ETF, COPX, ran up to $42 a share, which it ran to in January, ran to in April, and then it did it in July. So basically, like almost every 3 months in lockstep, and can't get above there. But it's pulled down. First time it pulled down to 34. Next time about 34 and a half. This time around 35 and a half. So that's creating what is called, folks, an ascending triangle: flat top, increasing bottom. So we're seeing that happen right now in a copper miners ETF. And I got to tell you, the real drag on copper prices and copper mining companies has been the Chinese economy. And they made a slight move this week with some lending rates that they lowered, but they didn't lower everything that the market kind of anticipated. I believe the Chinese come out at some point between now and the end of the year, especially if things stay the way they are, and some type of major influx of money, whether it's by lowering rates, whether it's by some type of large infrastructure infusion of money. Either way, it should be really good for copper. And remember, the demand for copper in the next 10 to 15 years, when it comes to EVs and renewable energy and building, the supply is not keeping up with demand. There's no way. It's impossible, in my opinion. So prices will go higher, and this is a nice way to play it with a group of miners. But again, I look at the charts and the stocks that are in here, and this is when it came up. I looked at the top 5. This looks the best. And this is Southern Copper, SCCO. Again, pulling back from a high, sitting on that price support from back throughout the year. Man, oh man, looks good right here. Again, folks, I'm not telling you to run out and buy any of these ETFs or stocks or anything. Nothing here is a buy or sell recommendation. This is all education and trying to get you to think outside the box that when a market pulls back like this and you have stocks sitting on support, that is the great time to buy. Because again, you're buying at a lower price, so you're buying at a discounted price. You're buying closer to support, so your risk is lower. So your reward to risk goes up exponentially when you buy on pullbacks near support. So it's very, very important. Even if you're a long-term investor, you want to buy on pullbacks. Why not? Stocks don't go straight up. They always pull back. So you want to buy in that pullback. So, overall, folks, I think this market, a lot's going to depend on what happens tomorrow with Nvidia. I think that's going to be extremely important. And then, of course, the Fed on Friday. When I say the Fed, I mean what Jerome Powell says at the annual Fed meeting up in Jackson Hole, Wyoming. But I think it's going to be volatile. We also have tomorrow the first Republican debate without Trump. Trump's doing his own little debate and debating himself, I guess, or something on, I think, Tucker Carlson. The other one will be on Fox News. Who knows what comes out of that? Maybe something, maybe nothing. But all that does is lets us know that we are getting into political season. A little over a year away from November elections. We have a lot of crazy stuff going on in the world right now. This is only going to add to the madness. This COVID headlines that they keep coming. Interest rates, keep getting headlines about mortgage rates at the highest level in 20 years. I mean, the negativity out there is quite insane. And the fact that we're only about 5% off a year high for the S&P 500 tells me something, that there's still really good, strong market breadth underneath here. And that I think there's still great buying opportunities long-term, and innovation is not going anywhere. I don't care if Nvidia falls 20% after its earnings on Wednesday. Nvidia is still going to power artificial intelligence. At some point, if it does that, I'll probably recommend it to my subscribers when I see fit. But it could be up 20%. I don't know. We'll talk about it on Thursday for sure, though. Also coming up on Thursday, a great guest I sat down with this past weekend. We're going to have an interview with former governor of Texas, Rick Perry, longest serving governor in the history of Texas, former energy secretary as well for 2 years. We're going to talk about energy, the grid, what's going on in the world right now, everything from renewables to fossil fuel to nuclear. You'll be interested to get his view on nuclear power going forward. So we have that coming up on Thursday. That's a must-watch interview. But until then, folks, have a great midweek. Enjoy life. Go out there. Spread one optimistic thing. And if you're going to post something on here with a comment, which I hope you do, post one optimistic, and then you can rip me apart for the next 5. But again, don't forget to like, subscribe, and again, have a wonderful middle of your week. We'll see you back here Thursday. I'm McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.